Hello, welcome back. So the market is going strong today, as you see here, we're up quite significantly right now, as we are open in just a few minutes. And today I wanted to take a little bit of a look at Shopify. It is a stock that I wanted to own at some point, but it has always been expensive, and today is up significantly after earnings. We're going to examine the earnings and also see what happened with the stock price through the years, because it has crashed significantly at some point, and it's down from its all-time high. So we're going to examine all this. But first things first, the thing that you kind of want to see here always is the stock news module in our tool. Obviously, all our patrons have access, and if you're interested, there is a link in the description below this video. But you will see here why are Shopify shares soaring after earnings, pop 15% on earnings and all that. So big profit beat. So what happened here during the earnings report? Let's take a little bit of a look. Now, the key points, they beat on top and bottom lines, so this doesn't mean that they made an insane amount of money. It means that they beat on expectations. So basically, the analysts of the people who are actually analyzing the company's financials were expecting some values, and the consensus was actually lower than actually they achieved higher results than the expected consensus, which was for potentially lower outcomes. Now, it also gave a bit guidance, which is super important as well, because especially when a company is a growth company, you do want them to have as good guidance as possible. So this definitely played a huge role with the stock's price today. And earnings per share, 24 cents adjusted, that is, versus 14 cents expected. As you can understand, this is pretty significant here, like a massive bit indeed. Now, I have talked about it in videos. I have made a dedicated video about it in my channel, explaining what adjusted means. And typically, companies do that when they are not profitable. They use adjusted earnings, excluding some of the expenses, and it does make some sense in some situations because you have to compare through industries. But typically, when you see adjusted here, it usually means that the company is actually losing money, but they're losing less so than expected. Here is what is happening, and this you in many situations you see it as EBITDA, which our tool provides as well. And EBITDA is the earnings before income taxes, depreciation, and amortization. And if you take a look at our financial statements here, for instance, for Shopify, you can kind of see here that the EBITDA of the company at some point was negative, then became positive, then negative last year. And so now it seems like we're going better than was expected from the analysts. This is the thing. With obviously the last year not being great for the company, as you'll see, the net income was down quite significantly. So this is what this means. And Shopify expects 2023 revenue to grow at mid-20s percentage rate, which is fairly nice. And again, if we take a look at our tool, you will see that the company's growth has been tremendous. So last year was again like 21%, which was less than before, of course. But 20% is pretty nice growth here, mid-20s, maybe 25%, not bad at all, driven by fourth quarter revenue growth in the high teens. And as you'll see, there's an increase in sales here on merchandise, 22%, and the results show the durability of the business model and all that. And net income for the quarter was 718 million, or 55 cents a share, compared to a loss of 158 million. Remember, this is the quarter, right, not the year. Pretty solid now, so they are back to making money as well. So that's nice to see for the company. Now, let's take a look at our tool, bearing that in mind, the fact that the company is kind of going back to profitability after having some bad quarters. We take a look at our metrics page here, and you will see that we are coming off of negative values. Again, the company is a company that has been doing well, then losing money again, then doing well, then losing money. This is the story, and this is why you are seeing these slopes here. At some point was very, very expensive, then it became much less expensive, then went to negative territory. So it's a little bit of going back and forth here. And the company obviously was selling shares at some point, issuing shares because they were making money. The stock was expensive. And if you take it back to 1 year, you will see, for instance, the stock was at about 70. But if you take it back 3 years, you will see that the stock was even more, way more, significantly more than 150, for example. and take it back 5 years, for instance, you'll see that the stock has been going down for the most part in the past couple of years or so. So this may be an interesting case here, interesting opportunity, although 20% today, 21% adds significantly to the overall price of the stock, which used to be 48. But I kind of wanted to take a little bit of a look at the cash flow statement as well. It's interesting just to see what has been happening through the years for the company. The net cash, the operating cash flow, you will see that it has been juggling back and forth from 10 million, 70 million to losing some millions here. And then again, the free cash flow has been in negative territory, then becoming positive again. Again, it's a story of a company that has been going up and down, and it's all about getting it at a cheap price, pretty much. And if you take a look at the metrics page again of our tool, you will see that currently the current market cap is about 74 billion, which is pretty lucrative. It's pretty expensive here. It's a pretty high market cap. And the thing is, does it justify it for the price? I'm interested to see what about the social trends. Yeah, the tool also tells you about social trends, especially on stock tweets, which is where the whole discussions take place. You will see the sentiment is really bullish right now as the stock is up significantly. It's being discussed quite a lot, understandably so. And so let's go back to our stock evaluator tool, which will tell us whether this one is a potential buy and at what price. Now, we know that the company's projections are, as the company projected, they're going to be growing at about 20% or so. Yet we're going to be a little bit more conservative, and we're going to go 13, 16, and let's go 20 for the high one. And they said mid-20s, so it's probably going even more, like 25%. Now, this is a 5-year projection period, though. So we are assuming that the company is going to grow 13% every year. So assuming 25% may be a little bit of a stretch, if not quite some stretch. And the revenue growth that the company has been achieving overall, the average, of course, the tool tells you about the averages, is 54%. So on average, the company has been growing tremendously, but it has been skewed upwards by 2020, for instance, where it grew tremendously. So, and downwards, I suppose, from 2022, where it went down in regards to growth, but still growing at a pretty solid pace. Now, the margins of the company all over the place, understandably so. Tough to justify, tough to say exactly what they are going to be, because you'll see that the company has been making money, losing money. They're at a stage where they are accounting for the adjusted earnings and all that. For that reason, I'm going to go with something that probably makes the best sense, actually, when the company is near profitability or is approaching profitability. I think they are going to be somewhere around the 10%, if not a little bit less. They could be more eventually if they become profitable, because it's a software company pretty much. And so I'm going to go, again, a little bit more conservative here. So I will go 3, 5, and 7. Again, because the company is not really profitable every year. So I don't have numbers here that dictate what I should be using on average. We have some years where the company is losing money, some years where they're making money. So we have to go with something that makes sense, but it's not too aggressive or not very conservative either. So probably 3, 5, and 7 does make sense. And again, the same thing for the free cash flow margins. We don't have much to work with here because the company has been losing money some years, making money some years in regards to free cash flow. So I'm going to use a typical value, 80, 90, and 100 is what you typically see out of companies. 13% for the annual return that we want to be getting out of our stock as a return, basically. Let's hit calculate and see what we're getting out of this. And understandably so, because the company is not really profitable every year, and they are juggling back and forth in regards to profitability, you would get significantly lower values than the current price. And remember, it was 48 actually before today. So at 58 is very, very expensive, and it's one of the core reasons why the board has been selling stock, has been issuing shares. And so even though they are doing great in regards to their earnings report, it's just not the price that I would want to get. And it has really skyrocketed because of hype, obviously, and it has gone down because the hype dissipates at some point, goes down, dies down, and you could end up losing money. So I could potentially want it in much lower values here, like for instance, it was 25 here back in October, and so it really grew from there. obviously it could keep growing, who knows, because the market is all about the sentiment as well. But in regards to value investing, in regards to getting something that has good value today, I just don't think this is a good opportunity here. It's probably a wait and see. Maybe at 20, there was something to say about it. Even then, it would be expensive, but it would be much more interesting. But at 58 or 60 right now, it's probably a little bit more expensive than what I would like to chew. So thank you for watching, guys, and I'll see you in the next video. Bye bye.